Ladies and gentlemen, starting the business is very easy. You can start the business today with more plan of actions, whether it is informal or formal. But running the business with an objective to create the good profit in the business is too difficult. You must have a more plan and the actions that how you are going to define and drive in your business. Because when you are in the real world, you would have more competitor, you would have more challenges, you would have more risks that you have to face and win. Now the questions here is that as an entrepreneur or as a business owner, how much you are sound in the financial performance and understanding the financials number. That is more important. Working as an entrepreneur or as a business owner, not able to understand the financial performance number, the drivers of the financial performance and the indicators of the financial performance, it means you are not growing to your business the way you desired for, the way you planned for. Because over the period of the time or sooner or later, you need to understand the financial performance and the drivers of the financial performance. Then what is your assets, what is your liabilities, what is your equity, what is your income, what is your expense, and what is your profitability. You should know about this because profitability that you have set the target in your budget, in your forecast, that is the part of the financial performance. That is the core part of the financial performance. And when you start to create the profitability that show the measurement of your potentials, then how your business is growing. So with this, when you talk about the financial performance and the drivers of the financial performance, which are the assets, liability, equity, revenue, expense, and overall profitability, these are the drivers of your financial performance. Now, how you are going to measure these drivers? What are those ratios? What are those indicators that you should know in your business? Let you please understand this indicator. Some of the indicators I would like to bring in front of you that you should know, and basis of that you would be able to know about that where your business are. The gross profit margins. What do you mean by the gross profit margin? Gross profit is simply that what you have the revenue and what you have the direct expenses. The direct expenses means that for running your particular business, that all those expenses which are directly linked to your business is to be covered and considered under the direct expenses. For example, if you talk about the airlines business, what are their direct costs? The fuel cost, the loading, unloadings, the passengers related, all those costs. When you talk about the logistic, all those costs that can be for running their business, like when you talk about the direct cost, that is the co-loading cost, that is their all cost, that is transportation vehicle. These all are the costs that can be called and considered under the direct cost. Similarly, when you talk about the manufacturing sectors, all those costs that are directly in relations to the business productions would be considered and covered under the direct cost, isn't it? So the gross profit margin is more important, that you should know as an entrepreneur or as a business owner. Then what is the gross profit that you have set the target, and what you have the gross profit in actual, that you should know. And it is very simple. That for example, if you have 100 rupees of a turnover and you have a 60 rupees of a direct cost, that means the direct cost that is in relations to your business, that is in relations to your productions and service of your business. These all are the cost. So the 40 rupees that what you have earned is called as a gross margin. Now you need to understand that what you have created in your budget, supposingly you have created in your budget that you would be create a 60% of gross profit margin. Now here you have created the 40%, so the variation is 20%. You as an entrepreneur or as a business owner need to understand this, and you have to find out that where the direct cost is significantly incurred more. What are those root costs where you would be able to control more your cost? Then you need to find and able to give the answers to your business. With the gross profit margin, then you should know about the net profit. The net profit means all those costs, whether it is a direct, indirect, fixed, variable, semi-variable, all those costs is considered under the net profit calculations. So when you have the net profit, you need to again find out that what you have the projected net profit and what you have created the actual profit. You need to ask to the finance department the variation analysis, the where and what cost has been increased more and why it has been increased. The respective department, the respective stakeholders who own to those department is need to give the answers to these costs, that why they have increased, why they have not factored those costs at the time when the budget was prepared. You have to ask some questions and you need to create the brainstorming sessions with the different stakeholders of the departments, and then you will find that why the gross profit margins and the net profit margin has not increased. Then you need to find the third ratio is about the current ratio. What do you mean by the current ratio? These all are the financial terms, but as an entrepreneur or as a business owner, you need to understand that these are the indicators that can help you to find the positive financial performance. So the current ratio generally for the business and the right business is that your current assets should be double than your current liabilities. So for example, what you have the liquid assets, what you have the receivable, what you have the cash, what you have the securities, that value should be double as compared to what you have the trade payable, what you have the liabilities that you have to pay, isn't it? So your current ratios should be where current assets is double than your current liabilities. The current ratio is more important. With this, the liquid ratio, that means what is your ready-made liquidity that is available in your business, whether you can be able to convert and ready realize. Are you able to do that? That you need to see the liquid ratio as well, because liquid ratio is going to help you to find out that how much you have the cash and how you have the cash rich company. That is going to help you to create more. With this, the working capital is the blood of any of the organizations. Working capital is the blood. Like how you are carry your vehicle or car. For running your vehicle, to running your car, you need a petrol. So see the importance of the petrol. When you do not have the petrol, when you do not have the diesel, when you do not have the CNG, whatever may be, you are not able to run your vehicle. Your vehicle is simply stopped. No matter how the cheaper or the high price of your vehicles are, that is as usual not able to work for you. So the petrol, diesels or CNG, like how this is a critical part of your vehicles or car, in a similar way, the liquidity is the critical part of your business. So you need to find out that how much you have the CNG in your business, how much the petrol is in your business, which you can be able to readily convertible and create more and more business opportunities. With this, you need to find out the leverage. What do you mean by the leverage? Leverage will help you to identify that what is your risk in terms of debt in your business. How you have the risk analysis. Leverage will help you to find out that if supposedly you have the good current assets, you have the good cash, you have the receivable, you have the debtors, you need to find out that how much you have the debt that can be compensated with this all the receivable or the liquidities. If you have a more debt than the ready realizable assets, it means you are leveraging the negative points, and negative leverage will create that negative impact in your business. So leverage is one of the gravities that can help you to identify that where your business are and how your business is increasing the potentials in terms of the liquidities. These are the importance. With this, the return on investment or return on your turnover or the returns on your whatever the investments are. This is very important. Why you need to see the ROI is that whatever the investment you have done and what returns you are getting, supposedly you have the profit, what profit you are getting on the sales, what profit you are getting on those assets. Because when you are purchasing the assets is indirect or indirectly utilizing to create the revenue, isn't it? Yes. So you need to see the returns of your profitability with the different, whether it is the assets, revenues, investment, and you need to find that what is the return percentage with these all the transactions that you have done, whether it is the sales, whether it is the investment, or it is the assets. So these are the indicators that you need to understand and create the right system and structures in your business so that you'd be able to factor, you'd be able to know about this all. Because the financial performance, when you are talking about the profitability, and it is whether it is gross profit or the net profit, it is the indicator and the measurement of your potentials in the business, and that can add more values. When you have the more profitability, you are growing more, you are adding more values, you can be able to create more assets, you would be able to create more investment, you would be able to manage your business effectively. So the drivers of the financial performance and the indicators of the financial performance are the supreme part that the finance functions or the department can help you to understand and give you the correct pictures then where you are and what are those numbers that you need to project more in order to cover all those risks that you have catered for. That is more important. So as an entrepreneur or as a business owner, when you are in a business, you need to understand all those drivers, that how these drivers are adding the values in your business, how you are able to see the matrix and the business values through these drivers, whether these drivers are impacting to your business overall, and what are those indicators that can help you to create the right and sustainable business in order to know about that, whether the indicators are positive. If these are the positive indicators, it means your drivers of the business are going to the right track and you will be able to create the more growth in your business. These all are the financial terms that you as an entrepreneur or as a business owner should know. For more details, I would be create more and more financials, reportings, and the business model that can help you to know about that how this business model would create the overall opportunities in your business. What you need to do here is you need to watch the video, like the video, subscribe the video to get more and more fruitful informations that can help you to create overall growth in your business, isn't it? That is more important. This is Singh signing out. Until we meet again. Thank you. Thank you very much.